So, hello everyone. It's a pleasure to have you with us. My name is Pierre Schlosser. I'm an assistant professor of political economy at the European University Institute, and it's a real pleasure to have you with us today. We have little time, just an hour, and want to discuss big questions. So let me be very brief in my introduction, but say the essentials on who we are, so that newcomers who are not completely informed are not in the dark from the beginning. So the Florence School of Banking and Finance was set up in 2016 as part of the Robert Schuman Center at the European University Institute in Florence in Italy. Our school is a leading center, a knowledge center in Europe, and has put it in its young history a key emphasis on developing capacity building initiatives with European institutions and agencies. And in this context, we'll host two courses to mention that to the community in the coming months that I'm sure will be of great interest to this audience too. One that will be in June on blockchain and decentralized finance DeFi. We're really at the last days to register, and one on financial markets infrastructure in October. Now, we'll explore today the role of distributed ledger technologies and asset tokenization in advancing a very political agenda. So there is a mix of technology and politics here that is quite interesting in advancing the capital markets union in Europe. And this is clearly a quite novel territory. So let me be clear at the same time that we don't want to spend an hour together celebrating the benefits of new technology. So instead, what Andy and I had in mind was to bring together voices from the private sector, policymaking, and academia in the context of a highly fragmented European financial landscape. Our logic is the following. After a decade of trying to build something like a capital markets union, could there be something like a silver bullet that wasn't exactly invested enough thought into, meaning could DLT offer a level playing field to enhance capital mobility across borders? We're very ambitious in the number of questions that we thought we would address. So let me mention a few of them. First, what are the policy implications of a growing reliance on DLT in the European financial system? Second, what risks accompany the widespread adoption of DLT-based tokenization? Third, what steps are necessary to fully integrate DLT into European capital markets? And then going on towards, let's say, more the regulatory and policy and political side, is the so-called level 1 legislation needed to support that integration? And in that also relationship, could DLT-based markets serve as the 28th regime to transcend persistent national fragmentation? There are a few things that are a bit technical, so we'll make sure that we introduce the terms each time we mention them. And now I'm really glad to be in the company of great speakers and great experts today to address these questions and have this conversation together. Starting with Andrew Whitworth, who is from the European University Institute and EA. Thanks a lot, Andy, also for organizing this seminar, this debate today. We have also Isadora Arredondo from Hedera. Thank you very much, Isadora, for joining. We have Tim Meirer from the KfW Group. We have Louis Bertucci from the Institut Bachelier, who is also one of our key teachers in the EU SDFA, so the Supervisory Digital Finance Academies that we run here at the UI. And we have Leonardo Giani from the Florence School of Banking and Finance at the UI. Because we have only 1 hour together, I mentioned that already, I'll give every speaker about 7 minutes for an initial statement, and then clearly there will be time for questions with the audience and possibly also among speakers. So with no further ado, Andy, the floor is yours.
Great, thank you, Pierre, and thank you all for joining. So I'm really going to just sort of frame the discussion in my remarks, lay out some of the issues, and put down the groundwork for the wider conversation. So it's structured in 3 very short sections. One, a quick definition of some of the terms. Secondly, look at the EU context. And thirdly, the international context. So really, I want to stress the political angle that Pierre mentioned. For me, yes, tokenization, digitalization is and should be a pillar of capital markets union. But really, the point is to link this with wider EU political strategic objectives. So for me, it's not really a talk about regulating or not regulating one piece of innovation in one sector. It's bigger than that. It's very much in line with the EU's turn to geostrategic or geoeconomic competition. And I'm hoping this event as well will actually be the start of a longer discussion, longer piece of work from the EUI, which does have in my opinion, vital role in supporting the EU and thinking through a lot of these questions, the possibilities, implications of tokenization for CMU. So really the play, in my mind, the political play about tokenization in the discussion with Capital Markets Union is twofold. First, using tokenization to complete or even build Capital Markets Union. So, an EU-wide, modern, efficient capital market that spreads savings across the union, puts it to productive use. I think we're all going to talk about that quite a lot. But secondly, also, this, in my mind, is a play for EU technological autonomy, a way for the EU to boost its own economic technological level and use that to boost the efficiency of its markets and start to wean itself off perhaps international tech companies, but also position itself better for a fragmenting global financial system. So firstly, just to outline kind of what we're talking about, what is tokenization? How does it fit into Capital Markets Union? As I say, incredibly superficially and quickly, because we're all going to be talking about this in some level. But just make sure we're on the same page with definitions and things. I would define that tokenization refers to the process of converting ownership or rights to an asset, what slightly annoyingly are called real world assets, or RWAs, which is obviously an acronym already in use, but converting ownership or rights to an asset, an RWA, into a digital token on a blockchain. And by representing these RWAs as digital tokens on a blockchain, their ownership can be divided, transferred, and traded more efficiently and securely. So I'm not going to go into more depth on that here. The link to capital markets in general, leaving aside Capital Markets Union, very briefly, is just that tokenizing real-world assets can improve the way capital markets operate by making them more accessible, more efficient, more liquid. So secondly, moving on to the EU context, there are a few areas of EU political interest where tokenization can be attached. Naturally, in the regulatory, financial regulatory space, it touches on MiCA, the Markets and Crypto Asset Regulation, and MiFID. At this regulatory level, for me at least, and I may be in a minority here, but is relatively banal, I think. The challenge for and from tokenization is not primarily about regulation in my mind. It's about ambition and what future structural changes to the single market we, the EU, wants to see. The tokenization is obviously also related to the digital euro, so the ECB's CBDC project, and the stablecoin requirements in MiCA. If you have a tokenized market, you need to have a digital settlement asset, whether that's public or private. I think we'll talk about this a bit later, particularly in reference to the EU's DLT pilot. But more to the point, and where I think tokenization really has a part to play in Capital Markets Union, is it would create a de facto type of 28th regime for capital markets. So at a stroke, it would create an EU-level method of sharing capital market operations across the Union through allowing direct access as well as passport direct operations to access tokenized assets through passporting firms. So really the idea here is that we can make a political swerve from requiring or trying to harmonize long existing member state laws and norms around property rights and taxation, for example, which is kind of what's bogged down Capital Markets Union so much in the past, and open up a new new market at the EU level above it, and one which is particularly suited to cross-union single market access because of the transferability and direct access inherent in blockchain-based finance. I don't want to be dismissive. There is stuff to talk about in terms of regulation and policy towards tokenization, but for me, the crucial point is that supporting EU-wide tokenization market, the EU is not just taking a step towards completing and future-proofing its capital markets, but also boosting EU competitiveness against other jurisdictions. Which takes me to the third final point on the international context. We're not the only people on this call. Sorry, I've got a little light on my screen. We're not the only people on this call coming up with this idea. The EU is not the only people thinking about it. Powers jurisdictions around the world are looking to tokenization as a potentially fundamental shift in the nature of economic activity. This in itself is quite interesting. I think there's a discussion to be had about whether this is just financialization on steroids or something else. We're not going to get into that here. But speaking globally, we see a shift in position in the USA coming from the change in administration, presidential administration, and the position of the SEC. So SEC Commissioner Hester Peirce recently laid out really quite a positive vision for tokenization and how it fits into the SEC's mandate. Compared to the previous stance of the Commission under the last administration, she highlights to her mind, significant benefits tokenization can have for increasing access to financial instruments, improving liquidity, and thus enhancing efficiency of financial markets. What she's doing is she's planting a flag for tokenization to be within the SEC's remit, but contrary to the previous SEC position, she's doing it in a way that seeks to promote, support, and build the sector in the US rather than block it. In the UK, similarly, there's growing interest among politicians, in particular, on the potential benefits of tokenization. So the UK's Digital Security Sandbox, DSS, is in some ways a counterpart to the EU's DLT pilot, but it was deliberately designed to be easier for funds to enter through less restrictive limits and a wider range of activities permitted. And at the same time, on the public sector, HMT, the UK government treasury, has announced plans to create a digital gilt, so UK treasury bonds, as a pilot inside the DSS, showing a willingness for on-chain first style of issuance, if it all works out and they're happy with it. So following the government's cue, UK regulators are very open to discussing how tokenization might fit into the UK's future crypto asset regulatory framework, or financial market framework, which, unlike MiCA, doesn't exist yet. There may or may not need to be legal changes. There was a recent update to UK law by the UK Law Commission, which creates a third category of property for virtual property, which creates a very clear and firm legal bedrock for tokenized assets, regardless of any future regulatory treatment. And more globally, very quickly, I mean, the UAE ADGM, so the Abu Dhabi Free Trade Zone, has created a framework for security token offerings. VARA, the Dubai Virtual Asset Regulator, has just had a project with the Dubai Land Registry to have on-chain property, real estate records and trading to allow tokenization of real estate. Singapore has a sandbox regime for tokenization. Japan's developed a regulated market for tokenized securities. Japan Exchange Group, JPX, are exploring tokenized bonds. So to conclude, my position is that tokenization can support the EU's drive to complete CMU and promote the EU's international competitiveness through that. So it's a political play. In that sense, it's at the same time beneficial innovation for its own sake, building a tokenization market that can make financing more efficient and equal across the EU. But it should also be seen as a core pillar of CMU that can unlock some of those old, quite stale political debates about how to finalize it. In this sense, I would call it a sort of 28th regime for capital markets. Now, look, I don't want to say that tokenization is the only part of capital markets union. I don't think anyone would say that, but it should be included. This technological pillar should be included and maintained as part of the discussions. And as I say, the EU, in my mind, doesn't have the luxury of deciding whether it wants tokenization to happen or how it's going to happen. It exists already. It's happening. Other jurisdictions are moving ahead. It's about how the EU can make it work for its own purposes. So I'm going to stop here. I'm aware I've just been able to set the scene, kind of open up a couple of areas of conversation. A lot of other speakers are getting into more detail on this, so I'll stop here and pass on to back to you there.
Many thanks, Andrew. Indeed, I think that it's fascinating how the interplay between technology and regulation is just there. But we're going to park this for a moment and address this in the second half, let's say, of this debate. Let's dig a bit deeper into the potential of tokenization, looking at market developments, but also technological development. Isadora, please, the floor is yours.
Thank you so much, Pierre. And Andrew, I'm so happy to see we're so aligned in terms of our understanding and ambition for this project. So I remember when I first read the SIU document, I was very encouraged by sort of the level of ambition and vision for the case for Europe. And I was kind of that enthusiasm started fading when I saw that the word innovation was constantly mentioned, but never in reference to the technologies that would underpin such a strategy. Now, of course, as Andrew has said, achieving a fully integrated capital markets union is not just about a technological upgrade. It's a complex harmonization exercise across legal, supervisory, regulatory regimes that has taken many years for that very reason. But I very much share Andrew's and Piero Cipollone's views that modernizing the technologies that underpin capital markets should be a core plank of an integration strategy. And new technology should not just offer ways of fixing things, but actually thinking structurally about how they work and how they can be improved. Now, tokenization at least holds the promise of leading to innovation at a product level and an infrastructure level. Andrew quickly walked us through the various benefits across streamlining financing for companies, easing the use of any assets as collateral, supporting broader retail participation in capital markets, and streamlining the entire asset lifecycle from trading and pricing to clearing and settlement. Also, the use of emerging technology can help support public policy objectives as well through the use of subtech and regtech. So it's important to notice that to understand that this technology is not just about advancing commercial objectives. But But so to just frame a bit the conversation in terms of what makes the blockchains different to, or distributed ledger technologies different to existing FMI data structures, because functionally they mirror a lot of the traditional roles that they play. In my mind, there are two distinctive components that we should look at in more detail. One is programmability, and the other one is open layer neutrality. Now, when I talk about programmability, what I mean is the use of smart contracts to enable composability and atomicity. And composability is, in essence, kind of ensuring the interoperability across smart contracts and protocols in a way that resembles kind of true open finance. Whereas atomicity refers to the inseparability of multiple transaction steps. And then moving on to open layer neutrality. In principle, it means that the data structure on which assets live is open and cannot be unilaterally modified by anyone. I say in principle because, as we all know, there are different protocols and governance mechanisms to restrict or open access to participation, as well as solve for the single point of failure problem, which I'm sure we'll deal in more detail. So now, while programmability is not specific to FMI, current FMI programmability does exist, but it's basic and it's asset specific. And what I mean by that is that we don't have composability and atomicity because different types of asset reside on single ledgers. So if we think about commercial money, we think about central bank money, we think about securities on CSD. So that basically prevents the inherent interconnectedness between transaction parts. If we think, for instance, about DVP, that requires intermediary guarantees. So the concept that is very unique to blockchain specifically is that of promoting open layer neutrality. And, I think it's important to contextualize, the historical moment at which kind of the Bitcoin white paper was produced and the iterations that we've seen from a market point of view since then that have tried to solve this idea of inclusivity, participation, and transparency. And they were obviously, in reference to concentration of market power, to some extent market abuse and failure, and a desire to push for resolving those silos and those costs that are incurred as part of that buildup of let's call them concentration or monopolies in the market. So through that evolution of different market-based solutions to DeFi and TradFi problems, we've seen a selection of options evolve across two ends of the spectrum. One, I really like the analogy of, private permission blockchains being kind of like an intranet within the internet. And what that means in practice is that they were developed as a solution to help FIs, for instance, test the technology in a safe environment and get kind of comfortable with the idea of tokenizing without necessarily exposing themselves to regulatory or legal risk. At the sort of middle range of the spectrum, we have public and permissioned blockchains. And what I mean by that, and I know that there's a lot of dispute about terminology here, but so I'm explaining what I mean, is the access to actually building on top of the blockchain is public, but the permissions in terms of validating and participating in the consensus mechanism are restricted. And then we have at the other end of the spectrum, public permissionless blockchains, which this year are kind of the concept du jour, but they've captured, the collective imaginary, both from a policy making and from an industry point of view, because they are consistent with this objective of neutrality and greater transparency. Now, all of these different solutions bring benefits and raise novel considerations in relation to interoperability, operational resilience, privacy, financial stability, sanction coordination, which really require thoughtful and careful dialogue between sort of policymakers and industry participants, because there are we are seeing a range of private-led solutions emerge to solve for these issues. But how the puzzle fits together is where we are kind of not necessarily getting stuck, but where the complexity lies. And there are competing ideas and models as to what kind of like the successful project will look like. Will it be a unified ledger? Are we talking about a public infrastructure? Are we talking about a privately run infrastructure? People have different views for good reasons that are also political views as to how that project should play out. And basically, yeah, and then we also have the idea of multiple ledgers being interoperable, and how does that work, and how does that solve for existing problems that we have today? Just my closing remarks is that one point of contention or where we need to work things together more collaboratively is on this idea whether decentralization, full decentralization of infrastructure is a concept that the authorities are comfortable with, and what are some of the benefits and drivers towards that endpoint, and how can we build the right regulatory guardrails to fully achieve kind of the benefits of that end goal. My personal opinion is that DLT will lead to a gradual and then sudden transformation of public and private markets, and a combination of the above market-based solutions and public policy interventions that we will discuss will take us there.
Thank you very much, Isadora, for the really systematic also overview about potential applications and use cases. We'll go a little deeper into that by giving the floor to Tim from KfW, who has also, in terms of the past work of KfW, has been exposed also to some bond insurances which were DLT based, and the KfW, as a matter of fact, just came up with a report that is also outlining a few issues in terms of the ecosystem that should be there to make it work. So Tim, over to you.
Many thanks, Pierre. So good to be here. Many thanks for the invitation, and I'm happy to give you some insights into our practical experiences in the handling of DLT when it comes to integrate it into our general treasury and funding activities. As you might know, KfW is a German development bank and is one of the largest issuers worldwide in the SSA segment. So we are issuing about 65 to approximately 85 to 90 billion equivalent in euro year by year at the capital markets. So we have a natural interest and also desire to engage in digitalization and innovation projects. And in my team, which is dealing with capital market innovation projects, I have the honor to take care of digitalization and tokenization projects. And in that role, last year, we have successfully issued KfW's first 2 blockchain-based digital bonds. And given that we have a German focus and a German home, so to say, our natural habitat is the German jurisdiction. So before we have engaged in the practical issuances, we have taken a closer look at what the German law is allowing. And we need to take a step back to the June of 2021, because in that month, the German Electronic Securities Act has been come into life in Germany. And this act has enabled the capital market participants to issue digital bonds. And in issuing digital bonds, the German Electronic Securities Act distinguishes between 2 different strands. The one strand is only digitizing somehow or sort of catching up what other jurisdictions have already succeeded, but also opening up the crypto securities strand. And this strand is also in a European perspective seen as a quite innovative approach to enable the issuance with so-called new technologies such as DLT or blockchain in general. And this sets the ground for KfW to experiment with DLT. And it has driven us to the issuance of 2 bonds last year. However, it is at first use cases. Yeah, so for KfW, we have begun a learning journey, so to say. And the goal of our learning journey is to eventually arrive at scalable products. However, given that the market for DLT-based issuances and securities is still super young, the whole ecosystem is not yet scalable. However, we are happy to share our experiences and our lessons learned by, for instance, publishing our market maturity report together with KPMG that we have published earlier this year. And this report describes both our issuances. And both our issuances are differing in its own specifications. The first one that has a volume of 100 million is primarily focusing on the investors' engagement. KfW has around 500 to 800 different investors. So KfW's natural interest is designing bonds that meet the demands of our investors. And usually KfW bonds are bought from investors for two specific reasons. The first reason is our AAA rating, and the second reason is our strong secondary market liquidity. We could stick to our AAA rating for both our blockchain-based digital bonds. However, when it comes to the secondary market liquidity, given that the market is still young, it is not yet as deep and as liquid as the traditional capital market. So what I want to say with that is that we as an issuer are only one part of a whole ecosystem that jointly needs to move together to strengthen the scalability of the newly forming DLT-based capital market. So there is a number of lessons learned that, for instance, our investors that were approached by our 4-bank syndicate in our first issuance that has provided us with extremely valuable feedback. For instance, we have deviated in the issuance process from our traditional bonds in such a way that we made a public announcement in last year's May, opening up a 2-month period where we have granted investors who were interested in participating the chance to particularly engage with our planned issuances and check internally whether they are already internally ready to cope and deal with DLT-based digital bonds. And one of the feedbacks was that even though 8 weeks period sounds like a super long period of time, it has still been too short for many investors. Because they need to get internally ready for, by instance, managing new product processes and checking whether the specifications of our bond meets their respective investment criteria. And speaking of investment criteria, it brings me to another aspect that is still lacking, sort of, in order to help the DLT-based capital markets to scale up. And this is ECB eligibility. Because DLT-based digital bonds, and in Germany we are talking about crypto securities in accordance with the German Electronic Securities Act, are by current definition not yet ECB eligible. And when this feature is a necessary requirement for investors to make a buy or not buy decision, it of course prohibits some investors to participate. So we have understood that this feature is one aspect that the ECB and the Euro system can work on in order to help the DLT-based capital market to scale. Another aspect, and this is what I want to put another emphasis on, is having a cash solution that is connected to the DLT asset side. Because when it comes to the settlement of issuances, we need to somehow exchange the securities with cash. So it's the settlement process. Our experience is that the asset side of the security is working perfectly on chain, and we used Polygon, a public permissionless blockchain, for both our issuances. But the cash side is equally important. And our second issuance was part of the ECB's exploratory work on DLT-based central bank money. And this has put an enormous focus on the technicality of the cash side. because as KfW is primarily working with central bank money, our interest is that wholesale CBDC is of an high importance to also help the DLT-based capital markets to scale. And just to sum it up, there are some more aspects that we have discovered in our precise use cases. And if you're interested, I'm of course inviting all of you to take a read into our research paper. And I think we can share the link afterwards to you. But I'm now happy to pass the word back to you, Pierre.
Thank you very much, Tim. And actually, you made the perfect transition towards Louis because you mentioned the word cash settlement and wholesale CBDCs or digital euro, because I do think that that's where we're going to go in the conversation. I just wanted to follow up on one thing when you talked about scalability, because to me that links up also to a question that we received in the chat from Eva Michler, which is about the cross-border dimension, because the ultimate scalability that we would imagine, and that's a frame of the discussion, is really an EU-wide, and I don't think we're there yet, but I just wanted to connect with what you were mentioning on that. Louis, the floor is yours.
Thank you, Pierre. Good afternoon, everyone, and thanks for having me on this panel. So to reflect on what's already been mentioned by the other panelists, I'd like indeed to insist a bit on the precise role of cash in this digitalization of the infrastructure. I will also mention and briefly discuss about the risks of digitalization, that the risks that will impose on some actors, maybe on the system itself or on the system itself, and then to finish, I will also discuss a bit. It's already been discussed by other panelists, but I would like also to discuss about the role of the tech, the relation between public or private settlement network and the sharing of the benefits of this digitalization. So first, I fully agree that of course we must digitalize the settlement and the capital market union. It seems quite obvious, maybe for some actors. On the tech side, as Tim just mentioned, I think it works well for the asset side, on the security side. When I say it works well, of course, there are many challenges, some regulatory challenges, some financial or operational challenges that remains to be solved. But I think we can see a clear pathway toward the tokenization in general of any asset, whether there are large bond issuances as the experiments are currently trying to make, but also we can imagine like some smaller, I don't know, tokens or securities like real estate or stocks or things like this. So that being said, of course, as Tim mentioned, the cash leg is also extremely important. And on that side, there is less consensus on what to use. Of course, you must be aware of the really high pressure from the private sector with the large market capitalization of stable coins, in particular USD denominated stable coins. And of course, it's going to be extremely important whether the central bank, the ECB, if we're talking Europe here, is willing to issue central bank digital currency, or for instance tokenized reserves. So just to set the frame, when we talk about tokenized reserves, we are mentioning, broadly speaking, I mean the existing reserves that will be tokenized on a given settlement layer. Whether it's public or private, that's another question. And when we refer to wholesale CBDC, it's more like a new type of asset, or a new thing really, that will also be on the balance sheet of the central bank itself. So, of course, as you can imagine, it's really different in terms of operations and consequences on the market. Right now and very recently, I think the ECB and also the BIS, the ECB, based on the results from the BIS recent experimentation, I think they will be moving with a two-tier system, which essentially is going to some sort of tokenizing reserves first, with something like a message protocol related to the existing target system, because, as I said, that can be actually implemented quickly, or at least quicker than issuing a brand new wholesale CBDC. So that's going to be interesting, I think, to see how it plays with automatization, with smart contract, with how we can integrate and how actors can really integrate this to create, as was also mentioned previously, some form of atomic settlement and composability between different protocol and systems. So that's for the short term, and for the long run, they are still looking into building a wholesale CBDC. It's less clear what are the exact benefit and consequences of the two different systems. It seems like if you issue a CBDC, a wholesale CBDC, and if all the assets are not tokenized on the same ledger or the same system, it may create some fragmentation in terms of liquidity, because then the financial institutions will have to maintain some inventory in wholesale CBDC and also in tokenized deposits, if the tokenized deposits used somewhere else. So it's also important to think about that, and the recent move and the recent direction that they seem to take does not really solve this liquidity fragmentation issue, but it only postpones it. So it will come at some point, and it will be interesting to see what the results will be. But I fully support the decision of the ECB to move to this kind of two-tier system. It's probably the safest move to maintain experimentation, innovation, while still looking into more long-term possibilities in terms of cash on the blockchain, on the tech. I will talk about the tech in a minute. But right now, we also want to discuss a bit about the risk and the challenges that it will pose to the system in general. So, of course, we can think about maybe the most direct type of risk is, of course, the cyber risk, because when we move a lot of activity, operations, settlement, and everything on autonomous system, ledger, whether they're public or private, again, I'll talk about it in a minute. But this raises some very important questions. So you have first the risk, of course, the cyber risk of, I don't know, the contract itself or the tech itself, but that's also related to who is going to build this, and you have also the risk of, I guess, the service providers that provide services based on this settlement system. So this is something we should really take into account. For instance, it might seem a bit far away, but I have not seen a lot of discussion around that. But the quantum risk is really increasing. I think has really increased for the past few months. We know there are solutions because, as you may know, a quantum computer large enough that still does not exist today, but a large enough theoretical quantum computer could impose serious risk and cyber challenges. So it's also something that we should keep in mind. In terms of other risks, there might be something that we don't see that discussed too often, but I think there is this risk of concentration among actors and service providers, because if you move a large part of the settlement and the settlement system onto a blockchain or onto something that's quite technical and technological, some actors may have a competitive advantage in providing services on this system or infrastructure. So it's also something we should want to be careful, because that could create some single point of failure. And in general, we probably don't like when the concentration is too high. So that's for the risk. And in terms of to open up in terms of unanswered questions, and also to reflect a bit more generally, I guess the discussion between public and private network or infrastructure is really important. I don't see personally how the ECB, for instance, would issue. I mean, I don't see the ECB issuing anytime soon kind of a token or a CBDC on a public network. But this will create a very important competition setup, because we know that on public and permissionless blockchain, the intensity of the innovation is really high. And every year you have new protocol, new systems and things like this. So it's going to be very important for all the infrastructure, the financial infrastructure, to be careful to not be like outdated day one, you know, and they should really think about that. Of course, there is this kind of the power of or competitive advantage of the ECB to issue the money, right, the CBDC, so that can be something, but I will not undermine the competition from the private sector in terms of stable coins and public blockchains. And finally, maybe just an open questions. We think about the digitalization of capital market union as something beneficial in general, even taking into account the risk I pointed out. It's also going to be, I think, the responsibility of the institutions to make sure that the gain from trades materialized and are directed to the right people. Because if it's just in the end a benefit for banks and for existing infrastructure players, is good, but they should really, I mean, we should try to find to create a system in which the gain from the trades are really passed down to the end investor or the end users of this new potential financial infrastructure. And with this, I hope I was not too long. I will give it the floor back to you, Pierre. Thanks.
Thank you, Louis, and then for flagging also this last point about the benefits which should be distributed through the system and through its actors. So we've clearly seen that there's a lot happening on the interface between tokenization and central banking, and what the European Central Bank itself could do to foster this through different ways in the future. We've talked about settlement, we've talked about cash, we've talked about wholesale CBDC. So that's clearly one avenue for further reflection that will pick up in the Q&A. The other one is the one we discussed a bit less until now, which has to do more with regulation, with harmonized rules, with fair rules of the game in view of a capital markets union. I think that both is probably as important to discuss, but to get us started on that aspect, let me give the floor to Leonardo.
Thanks, Pierre. Thanks, everybody. Well, yes, the idea for me is just to try to contribute to one of the questions that Pierre raised about is level 1 legislation needed to support the integration of capital markets. And I mean, there are different pieces of legislation that we can look at. For instance, as you know, MiCA, the Market in Crypto Asset Regulation, entered into full application at the end of 2024. But the piece of legislation that I would like to focus much is about the DLT pilot regime, because I think that this this discussion is very timely with reference to the DLT pilot regime. Just as a very short recap, as you know, the DLT pilot regime was signed on the 30th of May 2022, and it entered into force on the 22nd of June 2022. It was the first among the proposal of the digital finance package that was enacted. And basically, it entered into application. It was applicable since the 23rd of March 2023. That means that is more than 2 years ago. Actually, I mean, it is a pilot regime. So the idea is that at a certain point there should be some check about the regime, and it is provided by the regulation itself. Basically, according to Article 14, ESMA shall provide a report to the European Commission by the 24th of March 2026. That means in less than 1 year from now, evaluating different aspects about the functioning of the DLT pilot regime. And after 3 months from that report, that is in 1 year from now, the European Commission must present a report to the European Parliament and to the Council with a cost-benefit analysis about 5 options concerning the DLT pilot regime. That are the extension of the DLT pilot regime for a further period up to 3 years, the extension of the DLT pilot regime to other kind of financial instruments, the amendment of the DLT pilot regime, the possibility to make the DLT pilot regime permanent through amendments to different kind of legislation, but also the option to terminate the DLT pilot regime. Before that time, the regulation asked to ESMA to issue annual interim reports. The first one of those interim reports was asked to the ESMA to be issued before the 24th of March of the last year. But this is the first thing that happened. That was on the 3rd of April 2024. ESMA sent a letter to the European Commission, to the European Parliament, and to the Council, saying basically, I'm just reading a sentence of that letter, that given that it was 1 year ago, given that as of the entry into application of the DLT pilot regime on the 23rd of March 2023, no DLT market infrastructure have been authorized yet, ESMA do not intend to publish a report according to Article 15. So basically, 1 year ago, there were no DLT market infrastructure authorized. ESMA clarified that there were 4 applications, and it also asked the Commission to clarify some points. The Commission answered at the beginning of May of the last year, and among the different points to clarify, one of the points that clarified was about one of the most perceived problems about the DLT pilot regime, that is about its duration, because of this review that should take place. And it ensured that, I mean, there is no, let's say, final decision about the idea to terminate the DLT pilot regime. And actually, the idea was that, I mean, there is no expiration date. So if no proposal is made to amend the regime, the framework should basically continue to apply. This was 1 year ago. 1 year later, I mean, now, at the best of our knowledge, I mean, as far as we know, only 2 DLT marketing infrastructure have been authorized. One is German-based, the other is Czech-based. And the latest development, actually in these days, are that exactly because there was this very slow uptake of the DLT pilot regime, 2 national competent authorities, meaning the French AMF and the Italian CONSOB, sent a joint letter to to the European institution, or at least they made, let's say, a public statement, and they, let's say, provided a paper with some solutions, possible solution to improve the DLT pilot regime. That basically they were focused on three main areas. These three main areas were a more flexible regulatory framework to encourage still experimentation, to broaden the scope and the long-term visibility, and to develop interoperability and raising market awareness. I'm going to finish just before concluding one, since I think this was mentioned in the previous contribution. One of the points that the two authorities made about how to make the regulatory framework more flexible was to authorize the expanded use of e-money tokens and tokenized deposit to settle transaction pending, and this is a possible problem, the introduction of CBDC, among many others suggestions. To conclude, the last point, this was the one of the latest development, apart from another one that was a few days later, on the 15th of April 2025, basically as a key part of the rolling out of the Saving and Investments Union strategy that was adopted 1 month before, in March 2025, the European Commission issued a targeted consultation on the integration of EU capital markets, and actually it included a number, quite, I will not say huge, but several questions about how to improve the DLT pilot regime and how to evaluate it. And this consultation is actually, this is the reason why, because I said that this discussion is very timely, because this consultation is open until the 10th of June 2025. So in a couple of weeks from today, and open to any question and comments.
Many thanks, Leo. So we have limited time available for the Q&A and for the round, but there is a question that I'm very keen that we give an answer. But I'd like first to give the floor to Andy I mean, if you could give your view as to, is this a discussion that you anticipated to have in terms of, on the one hand, we can see that perhaps actually fragmentation dynamics may be actually higher than we thought would be. There is clearly a legal regulatory framework that has gaps. And when it comes to cross-border potential applications of tokenization, here I think there is a big question mark as to what can actually be done in the existing regulatory framework. So a key question I would have then in a second step to all would be, if you had one recommendation to give to on the one hand, the European Commission, and on the other to the ECB to, let's say, foster also an informed debate and action, if we agree that this is more or less beneficial, what would it be? But before that, Andy, just as an interim feedback from your side.
Yeah, thank you, and thanks for giving the floor. I mean, I think to your first point, or your first question, I mean, this was a discussion that I think we needed to have, that we need to have. I think we're still, even amongst ourselves here, and this is one of the things I'm hoping that we can move forward after this event. We're kind of having two discussions, which aren't separate, but they're not necessarily interoperable, to use the word. One is around developing, how does tokenization work? Partly that means, what does that mean for capital markets? So there's that kind of regulatory business market development point. And then there's the political points of competing CMU, and actually, is this good for the EU as a whole, and trying to get the political will behind it. And really what I hope from this event and going forward is to bring those two together, saying they should be seen as the same thing. Because obviously the point of Capital Markets Union is not integration for its own sake. It's always worthwhile reminding, but it's meant to have actual economic and social benefits to EU citizens and businesses. And this is why I said at the beginning, I think seeing tokenization as one pillar, or technological development as one pillar of Capital Markets Union, both has the direct effect of improving financial markets across the EU through the mechanisms that Isadora so well explained, but also can be seen as the sort of future-proofing, if you like, of Capital Markets Union and that political swerve I talked about. So So I think we are still kind of having two related but slightly parallel conversations. I'm not sure if you are.
Thank you very much. Yes, so I fully agree with you. Let's just give a minute to answer the question that Eva had, which I think to some extent we're already going into what she's saying. So I'll leave the funding side, I'll park this for a second, and I'll focus on the first question that Eva was asking. So she's pointing at generally problems of implementation. So she's saying with the capital markets unions, it's a problem in addition to technology that the real-world assets underpinning the tokens may not have cross-border appeal. So how do you first agree with that statement, and what could possible solutions be? Perhaps Louis to start.
Yeah, I'm not sure I'm the best probably person to answer this. I'm not. I don't know precisely how the real world asset underlying the token how it will impact the use of the actual token on the CMU. So if someone else has an input on that,
sure. Tim, Isadora. Otherwise, we move to my question on recommendations. That's fine.
Maybe just one or two thoughts from my side to the question. First of all, I fully agree because fragmentation is limiting an EU-wide adoption of DLT and tokenization. And I would like to put an emphasis on the ASAP model proposed from the International Monetary Fund. I do not know if you are aware of that model, but we really like it because it differentiates between 4 different layers. And I do not want to deep dive into all of them, but I want to shed some light on the infrastructure layer. And it is all about making sure that we have a DLT-based infrastructure that is, if not applicable to all jurisdictions, at least interoperable to other EU-wide and ideally also worldwide existing DLT infrastructures. And once we have some sort of unity or at least interoperability between those different platforms, tokenization and DLT and also competition can arise. And I think this is a sensible thought to differentiate those 4 layers and put an emphasis on the platform layer first when we are talking about scalability in general.
Many thanks, Tim. We have 2 minutes left, so let me give 30 seconds to Isadora, Leonardo, and Andrew in closing. Isadora, if you were to recommend one step in the direction of giving a bit more clarity on the use of tokenization in the EU, what would it be?
I think an openness to consider different paradigms in terms of how we approach the existing issues that we have with current infrastructure. I do think that we have seen a very rapid, well, maybe not rapid, but we've seen an evolution in the way that central banks and policymakers are thinking about these issues. They're taking them more seriously. But the reality is that there is a lot of kind of back and forth in terms of understanding and kind of really kind of reaping the benefits here. And it goes both sides, right? Industry also has to do its role in sort of awareness about actually like the private-led solutions that exist to some regulatory concerns. But I do think that from a regulatory perspective and from a sort of policymaking point of view, it's about like engaging meaningfully with this, not just as an effort to sort of appease or advance commercial goals, but actually, you know, implement it as core parts of their strategy.
Thank you. Leonardo, 30 seconds.
Yeah, in addition to what Isadora said, that I agree with her. I think that one of the main problems about the DLT pilot regime in particular was about the uncertainty, in particular about the duration, but not only. So the only, I mean, the main idea that I should have, the main suggestion that I can have is to make the system more predictable in terms of duration, but also in terms of content, avoid to overcomplicate the regulation in making it more stable.
Thank you, Leo. Andy, in a few seconds to close off so that we manage to stay on time.
Yeah, thank you. I mean, my only closing points would be absolutely to echo Isadora on the technical side. I mean, to keep regulators, policymakers should keep an open mind on the different trade-offs between these different public-private technological solutions, as well as between public sector and private sector provision of these things, which is not say one or the other, but understand the interoperability. But look, I mean, to close from my side, like, I think it's been a fantastic conversation. I really hope that we can do more events like this to push it forward, because, you know, 1 hour is not very much, and 5 experts are very good, but they have a lot more to say. So hopefully we can push this forward.
Absolutely. Yeah, I trust the conversation will keep going. Well, I mentioned a few of the courses we're going to offer in the next months, but we also have the USDFA as the Digital Finance Academy, where we have some of those conversations. So we're happy to have any one of you in Florence to continue that discussion. Thanks a lot. Have a good day.